Yeah, I think that does happen a little bit. I mean, it depends on what your attention span is. If you're an investment manager, you're trying to take a view on sort of some combination of fundamentals and sentiment over the next year or so. And if you're a trader, clearly, as you just outlined, you can be killed in 24 hours, and all your success of the rest of the years is wiped out. I think the other thing is that, I mean, throughout this year, because of the buoyancy of the US economy, because of the habit of a virtually 12-year bull market, that the S&P has kept trying to shrug off the sort of actions of the Fed. And it's a bit like a John Wayne movie. It's taking an awful lot of Federal Reserve bullets to kill the bullish sentiment. And the more the market sort of rallies, thinking this is just we can see the peak in interest rates, the more the Fed comes back and says, hang on, this has got to hurt before we can contemplate pausing. And so we've seen a couple of months where big relief rally because the Fed sounded a little bit more dovish or a bit more peaky. And then suddenly last week, he sort of punctured the balloon of optimism. But I stick to my view that next year we should try and spend less time looking at the bugs hitting the windscreen, much less the rear view mirror, and concentrate on the road ahead. And I think next year could be a year when the economy struggles a bit. There's a lot of stagnation around, maybe a bit of recession, but we'll be looking through the valley of the shadow of death into the sunlit uplands of 2024, when things could be looking a little bit better.
Yes, absolutely right. Enough of the Crimean War looking backwards. What about going forwards then in terms of the valuation of stocks with that as a premise? And Andrew, I hear what you're saying about what could well be a solid recovery platform that's being created. But in terms of valuations at the moment, a lot of our guests will come on and tell us we haven't factored in the earnings recession. How would you respond to them, sir?
Mm. I think particularly in the US, because the PE has come down in the US from sort of somewhere mid-20s to mid-upper teens. But that's against the background where earnings haven't really taken much of a hit, and there has to be some risk that for the Q4 earnings season, maybe early next year, that there'll be some earnings disappointment and a bit of PE compression. Elsewhere in the world, valuations are pretty low. Now, obviously, the correlations can tend to go to one. If the S&P has a howler of a quarter, everything else is going to be under pressure. But as I think Warren Buffett once said, don't ignore a decent value offer just because you hope that things are going to become even cheaper. Because as we've seen in the last 18 months, you never know what's going to happen for good or ill. And if you ignore, say, a lot of non-US markets on sort of low teens PE, let alone smaller caps on single-digit PEs, you may well find you've missed it.
Andrew, I'm just having a look at the top 20 holdings in the Witan Investment Trust, and what comes through very clearly is there's a real absence, I would say, of growth stocks, what we would think of as growth stocks, i.e. those technology stocks that have been tremendous performers over the last few years. Can you just walk us through the thinking with the trust and the positioning? Because I see banks, I see commodity businesses, I see drinks companies that sell into the consumer. Just explain to us what you're trying to achieve with the portfolio.
I think it was, our stock picking tends to be delegated to external managers, but by and large, there was a collective skepticism over both the valuation of tech, particularly, and it culminated a year ago, but frankly, I think we turned bearish too early, pre the pandemic, and then we were surprised by the extra surge in demand and the revaluation that we saw. It's felt a bit like waiting for Godot, thinking there's going to be a correction in the US and the tech sector, and I think it is coming through. I'm longing for the time when people can look at tech and instead of thinking, what rating am I comfortable to value it on? People can think, well, it's actually an acceptably valued sector, which we may not be a long way away from that in profitable tech anyway. And then it comes down to which companies you pick. So there's no top-down view, we want to be underweight tech or whatever, but I think where we're positioned for now is that we think that the undervalued parts of the market are those which are more responsive to an upturn in the economic cycle and also to a broadening of economic optimism, if you like, from the US, where it's well entrenched and for good reasons, to the rest of the world, which has been the financial market equivalent of Eeyore over the last 5 years.